Hi, welcome to Market Minute. This is where we look for opportunities in the markets. Yet, as you know, we hate to lose money, or I hate to lose money, so we protect the downside when we think it's appropriate. We think it's appropriate. The economy is slowing. The stock market continues to rise, but it's doing it in a really weird way. So looking at the economy a little bit, so M2 is a really important indicator. I had a really smart money manager say he can't believe that we're not in a recession already, given that money supply is shrinking. It hardly ever shrinks, and when it does shrink, it's a really important indicator for the economy and the stock market. So I pointed out that, yeah, but look, we are up so far above where we were at the beginning of the recession, up 43.6% to the high. We're now up, money supply is up 26% with that 5% decline. That's still a lot. So, what we think is happening is that the money supply growth has finally worked its way into the economy and is starting to become a negative. So it's going to be more indicative of what's going to happen in the future. If money supply continues to contract, you're going to starting to see some contraction in the economy. If it flattens out, the economy is going to have really start to struggle to grow. Looking at GDP, so perhaps the economy is starting to slow or getting ready for a recession. The first quarter GDP came in at 1.3%. So you can see this declining trend over the past 3 quarters here. We think what's going to happen in the second quarter is there's going to be some building of inventory. So we see that it looks like the order rates that are occurring last month were off in a really big way. So I think the ISM index is one of the best economic indicators out there, if not the best economic indicator that we know of. So when it's below 50, the manufacturing side of the economy is contracting. When it's above 50, it's expanding. It came in below 49% this month, so it ticked down. And the order rates of that index were down around 45%. So that's down close to a recessionary level. So you can see that the momentum of the economy is really starting to slow. The unemployment rate, it clearly has bottomed out. So from the bottom of roughly 3.4 at 3.9, we have an employment report on Friday, so it'll be interesting to see what happens there. But generally speaking, when the unemployment rate rises by 50 basis points or 0.5%, the economy is in a recession. There are currently about 40% of the states in the United States that are in a recession currently by that definition. So we think that the unemployment rate clearly bottomed and will likely go higher over time, and particularly as we go through the rest of the year. The stock market, as we mentioned, is starting to act really weird. So I couldn't believe this happened. So on Friday, this is the low of the day on Friday. From the low of the day to the close, the stock market went up 2%. So there's a large buy program, roughly $7 billion buy program, really drove the stock market up. So we think that the market is fully valued, overvalued, however you want to describe it. It's expensive. This is not a buy low market. This is a sell high market. This is where you want to start taking your profits, or have taken your profits and started to become more and more defensive. So at 21.7 times earnings, it's way at the upper end of the range, not far from the high that we had in 2000 or 99 at roughly 24 times projected earnings. So this is a good time to get defensive. We think we're in the final phase of this market prior to going into a recession. You know, this phase could last a while. It's a really difficult phase where you have fewer and fewer stocks going up. The market's getting more risky with names like NVIDIA and the rest of this Mag 7 becoming a bigger and bigger part of the overall stock market. So as we look at the S&P 500 as a portfolio, I don't like it. I don't like being the S&P 500. It makes me nervous. There's too much in technology, too much concentration. So again, the stock market is looking rather risky. It's starting to act weird, high valuations. As we go through the year, we think we might moderate into a recession in the second half of the year. If not, if Trump gets elected, we think he's going to take his recession. I think if Biden's elected, I don't think he has a choice. Like, he can't keep spending money the way he is, what he's doing. So sometime over the next 12 months, there's a high likelihood of recession in the overall economy. So look to your portfolios, weed the garden, get rid of the stuff you don't like. Think about what's going to perform in the next cycle up, and start picking off some of those names. Now, we mentioned natural gas, a few weeks ago, and commodities. We still like natural gas. However, the OPEC meeting recently was not good. They intend to raise production. That's going to put pressure on the oil market. However, we like natural gas for the long term, as we think it solves a lot of the energy needs of our country. BOIL, that's a double on the natural gas. It's been really volatile. I don't know if you've watched this, but it got back down to the level we first started buying it here recently, around 16. So we think at that level it's kind of interesting. Thank you very much. If you have questions, please come to my website, Patrick Adams CFA, and shoot me an email, or sign up for Market in a Minute, get a hard copy of it. We'll send it out to you every week. Thanks a lot.